So all these things, share capital, share premium, retained earnings, revaluation surplus, all this we show in the statement of financial position. So this is assets, this is liability and equity. In that we have equity section. Equity is nothing but share capital. So equity section has all this. This is the heading. It has share capital, the money what company has raised by issuing shares to public, X amount. It has share premium. Sometimes what happens, company issues shares at higher price and they get extra amount for that extra price what they are charging for each share. That's called share premium. Let's say company's share value is $1 and they're selling a share for $1.20. So extra 0.20 per share what they are getting into number of shares, whatever you want, you can multiply. It will be called a share premium. Then comes retained earnings. Every year company has to transfer their current year profits in an account called retained earnings account. This is also part of company's equity. Why this is part of company's equity? Because in future whatever the profit have got accumulated can be reinvested in any of the future projects. Okay, can be reinvested in any of the future projects of the company. Henceforth, this can form future capital. Then I yesterday told that whatever suppose company has a land or building, it has bought for $100,000. The value of that is going up. It has become $120,000, and this property company doesn't want to sell. They want to hold it. So the extra profit, extra income what is getting generated here is $20,000. That is called revaluation surplus or revaluation gain. This is a non-realizable nature income shown in other comprehensive income section. From other comprehensive income section you will be transferring this to equity, okay, which is there in the balance sheet. See what happens, equity has two things, one is retained earnings, one is revaluation surplus. Okay, retained earnings, in this you will be transferring current year profits. So you will be making this SOPL, and in this you will be starting with revenue. You will be deducting all the expenses. Finally you get net profit here. After that you make OCI. So net profit is, let's say, X amount. This will be transferred to retained earnings in the balance sheet. Okay, and whatever you are showing us revaluation surplus under OCI, you will be showing in the uh, like uh, equity under revaluation surplus account. Okay, 2 minutes only. So this will be going in the revaluation surplus. Okay. So all these things I wanted to explain you. But what is this statement of changes in equity? That is what is a important question here. The statement of changes in equity is nothing but when you start your company, okay, or when you start your year. Let's say this is the beginning of the year. In beginning of the year, let's say you had $100 in your share capital account. Okay, balance at 31st March 2006. Okay, let's say this is $100. Okay, $100. And this year, see, Umayya, please listen. The last year when you close the books, you had $100 in the share capital account. In this year, during the year, you raised some extra. You kind of issued some extra shares for raising some additional capital because you had some needs. So in that case, you were able to raise $20 more. Now you tell me how much is the share capital at the end of the year you have? $120, right? What does it mean? This particular account shows how much was the balance at the beginning of the year and how much is the balance at the end of the year for this particular headings, whatever we are seeing here, okay, which all are nothing but part of equity. Equity should be seen in the broader sense. It's not only share capital, but equity is also equity is the combination of all this what I've mentioned. That's the reason why it is total equity. So I had $100 share capital, 20 I raised, 120 I have at the end of the year. Premium account. Let's say premium account has nothing, $0. And like when I issued shares, we got $5 in premium account. So now $5 is the amount at the end of the year. Retained earnings opening balance was, let's say, $50. Company has paid dividends of $5 to shareholders, and total comprehensive income, let's say, total comprehensive income is nothing but the entire total of the comprehensive income. Okay, that is some $5, and some amount from, like, trans transferred from revaluation surplus to retained earnings. Why they have done this, I will explain you in the next session. Why some amount from revaluation surplus is transferred to retained earnings. So any transfer from any account would increase. If you get money into an account, the account balance will increase. And if the amount is transferred from revaluation surplus, this account balance will decrease. Okay, I will show that treatment. Here again, you got $5. So total amount is $65 here. Opening balance and closing balance, and revaluation surplus, you started with $10, let's say, and total comprehensive income, in that also some $5 of revaluation gain, and some amount has been transferred from revaluation surplus account to retained earnings account. Let's say that is $5. So 10 plus 5, 15, 15 minus 5, 10. So there is no change at all we are seeing at the end of the year. So this account is meant to see the changes in the account at the end of the year. Okay. Now there is an entry here on disposal. See, now we will do a question. We will understand some topic here. Okay. You should be understanding that topic very properly and clearly. The transfer from revaluation surplus to retained earnings above is allowed by International Accounting Standard 16 that deals with property, plant and equipment or tangible assets under two different circumstances. When will you transfer the money from revaluation surplus to retained earnings? There are two circumstances of that happening. Annually, the difference between depreciation calculated on revalued asset. Let's say you had an asset of $10,000 and now you have revalued that asset and the asset value is now $12,000. Previous depreciation was $1,000 at the rate of 10%. Now, since the revaluation of the property is done, you will be showing the property at revalued figure. So revalued figure is 12,000. Now $1,200 is the new depreciation and there is an excess depreciation of $200. Correct or wrong? Tell me. Hello. From previous amount of depreciation, the current amount of depreciation is more by 200 or not after revaluation?
Again.
Hello. See, this is the depreciation of the asset which we are having. Okay, asset value is 1 lakh when we purchased it. So depreciation is 10 at the rate of 10%. It is 10,000. Okay,
Yes.
sorry. No. Asset value is 10,000 and
Depreciation is
depreciation
1,000.
is 1,000. And now the asset has been revalued and the value of the asset has increased by 2,000. And now the asset, now the depreciation is 1,200. So from previous depreciation, the current depreciation is more by how much?
10. 200.
$200.
200.
This is called excess depreciation. What is this called?
Excess depreciation.
Yeah, so excess depreciation of 200 because of revaluation. What happens? The revaluation surplus is how much?
10%.
Revaluation surplus is $2,000, right? So now this is statement of profit or loss. This is net profit. This is other comprehensive income section. We will show the revaluation surplus in other comprehensive income section, right? That is $2,000. Now I am asking you a question, Umaya. Because of this $200 excess depreciation, your net profit will be reduced by this extra $200 or not? Please tell me.
Yes, it will reduce.
It will, because excess expenses will reduce the profits. Now you tell me, this particular expenditure which is reducing our net profit, does it belong to this or does it belong to this? See, there is a
No,
matching.
up one.
There is a matching concept, right? As per matching concept, if you are earning any revenue, if you are earning $1, there should be a cost spent for that, right? For every $1 earning, there should be a cost spent. So here, $2,000 we are making profits due to appreciation in property value. For that, there is some cost, right? Where should be show that? Where should be we showing that cost?
SOPL.
No, that cost, of course, we are showing that cost here. But this particular cost income, whatever we have to
Not income,
match,
right?
that income is not shown in SOPL. That income is shown in
How it is an income?
revaluation surplus is an income, right?
It's a depreciation, right? Excess
This
depreciation.
excess depreciation is shown in SOPL. I am not saying it is not shown in SOPL, but
Oh,
there should be some income to match this expense, right? That income, what we need to match with this expense, is shown in revaluation is shown in OCI in the form of revaluation surplus. Why did this excess depreciation got created? Because the property value has increased, right? Property value was 10,000. Now property value is 12,000. Previous depreciation was 1,000. Now depreciation is 1,200.
okay. Okay.
So the excess depreciation what has got created is because of this revaluation gain of 2,000, right?
Yes, sir.
So the income with which this expense should match is not there in the SOPL. It is there in OCI. Then what is happening? Unnecessarily SOPL's net profit is getting reduced by this $200. Am I right?
Yes.
In actuality, which account should be affected because of this? This particular revaluation surplus account. Correct or wrong? Yes.
This point I can't get. I just understood this. The
I'm explaining.
depreciation is in SOPL and the
Yes.
2000 is in OCI.
I'm explaining this. This particular expenditure, which is reducing your net profit, okay? It is reducing your net profit. Actually, this expenditure should be matched with this revaluation surplus, but it is not happening. So what we can do is, this is retained earnings account. This is revaluation surplus account. Since $200 should be reduced from revaluation surplus, it is not getting reduced from this, but it is reducing our net profit. So to show the correct profit, what we'll do, every time we will transfer $200 from revaluation surplus to retained earnings account. Are you understanding? So $200 will be reduced here and $200 will be added here. What will that do is, expenses are matched with the right account and unnecessarily our profit which was reduced by $200 now that will be corrected and we will be getting a exact profit. Did you understand?
No.
The point here is, let's say the net profit is $2,000 and the net profit is, let's say, $1,000. Okay. Your net profit, you are deducting $200 from this net profit, right? The excess depreciation amount. See, your excess depreciation is how much?
200.
This 200 you are reducing from your net profit, right?
Net profit, yes.
You are getting $800 net profit which you are transferring to retained earnings account.
Okay.
Actually your profit should be how much? Actually your profit should be how much?
1000.
Why 1,000? Because this 200 excess depreciation what we are showing here, this expenditure is not to be matched with this profit. It should be matched with revaluation surplus, correct? This expenditure what has got created is because of this income or because of other income? See, this 200 excess depreciation which has got created is because of this revaluation surplus or any other income.
Revaluation surplus.
So now this particular expenditure should be matched with this expense, this income, right?
Sir, that is a depreciation, right?
See, you're not understanding.
Yes, I'm not understanding this point. I don't know.
Listen. See, 10,000 asset value,
Yes.
12,000 revalued amount, $1,000 depreciation at the rate of 10. This one, 1,200 depreciation. My net profit is $1,000.
Yes.
Okay, and other comprehensive income I'm showing $2,000
Oh,
revaluation surplus.
okay.
Okay, so now what is happening is, actually my profit was $1,200, but I'm getting $1,000. This $1,200 from this I have reduced this depreciation. Correct? Depreciation belongs to P&L account, right?
Oh, hello.
Depreciation belongs to P&L account or not?
Yes, sir.
I'm asking, depreciation expenditure belongs to P&L account or not?
Yes. Yes. Depreciation.
So I have reduced this depreciation and I got the net profit. But I'm asking you a question. This expenditure of $200, which is excess depreciation, it belongs to, it should be matched with the net profit or it should be matched with the revaluation surplus, which is there in OCI.
This point.
This excess depreciation got created because of this or not?
Yes. It has
So
created.
this should be matched with this, right? But
Yes.
unnecessarily that we are putting in the P&L account and we are reducing our profit by this much, which is not right. So what we need to do the correction? We need to, how much we have reduced from this profit to get $1,000, $200, right? Excess depreciation. Now what we will do is we will transfer amount from this to that account. Now see, retained earnings account I'm making. In retained earnings account, how much is my net profit?
1000.
In revaluation surplus, I have put how much?
2000.
Now you tell me, actually my profit should be how much?
1000. Acha, 1200.
Why it should be 1,200? Because my profit was 1,200 and excess depreciation I have
Okay.
removed from that, right?
I understood.
This excess depreciation belongs to this. Now what I will do is to do the correction, since I have removed this $200 and I've got 1,000, I should get back what?
You're 200.
I should get back what? 1,200, correct or
200.
wrong?
So you're
I
adding
should
that
get back this
200
1,200 or
again.
not? Yeah, so what we will do is this, to get this 1,200, we will correctly match this expense with this income. That means we will reduce this expense from this income and then we are reducing, that means we are transferring this to this account. And now we have 1,200 here. Now is it a right treatment?
Okay.
Is it a right treatment or not? your excess depreciation expenditure has been matched with your revaluation surplus, and you have the right figure of revaluation surplus or not? Of course, this expenditure has to be matched with this income, right?
I understood this concept that why we are getting 200 in retained earnings.
That's what. Now I am matching it. As per the matching concept, I am matching this expense with this income. So that much of income will be reduced by this much expense. So how much is revaluation surplus now with me?
1,800.
And this particular, because of this excess depreciation, my profit has got reduced by 200. Okay. Actually, my
So you
profit
are
is
adding.
200. So I'm transferring from here and I'm adding here. Okay.
Hmm.
So the entry for this would be, the journal entry for this would be, that will give you a clear picture. The entry, see here, which account, from which account the money is going away? Revaluation surplus, right?
Hmm.
So revaluation surplus account will be debited. Why it will be debited? Because
Because
this is an income. When income is reducing, it is debit, right? Decrease in income.
it's
And
the
which account, which account the money is going? Retained earnings account. So increase in income is credit. So increase in income. That means now my net profit will increase by $200 and my revaluation surplus will decrease by $200. So it is decreasing, that's why debit. It is increasing, that's why credit. Did you understand, Umayya, now?
yes, sir.
Okay.
Okay,
So I
sir.
want you to go through this concept properly because I have another session. Because we did the correction, I wanted to explain your doubts. Tomorrow I will close this chapter, surely. Okay.
Okay, sir.
Because maximum explanation of complicated concepts are done. Tomorrow it will be very smooth, the smooth flow of the class. Fine.
Okay, sir.
Okay. Thank you so much.
Thank you, sir.
Thank you.